We'll go ahead and get started here. My name is Thomas Wood. I'm the Director of Trading Operations at Microquant, and we are happy to have Dan Passarelli here with us today. He's going to be talking about how low VIX can help you in your trading. He started his trading career on the Chicago Board Options Exchange, and he's written several books, and he is featured on many different news things such as Fox Business, Bloomberg Television, BNN Public Radio, Chicago Board Exchange blog, and has a weekly featured video on Chicago Board Exchange TV. So Dan, I'll let you go ahead and take it away.
All right, thank you very much. Glad to be here. Thanks for attending, everybody. We've got what I think is going to be an interesting presentation today. Oh, hi, Brew. How are you? We have got a couple of ground rules here. First things first, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago. Also, you can see in the GoToWebinar interface here that you can ask questions. Do me a favor. When you ask questions, keep them pretty short because, you know, like I like to read the questions to people, and when it's like sometimes every once in a while somebody writes in like a novella here and it takes me an hour to read questions, everybody loses interest. So keep it to like a sentence, keep it pretty relevant. I'll take some questions during the class, but a lot of them I'm going to hold till the end, and I'll stick around for a while answering questions, guys. So I highly encourage questions. Alrighty, let's talk about volatility and options. Ladies and gentlemen, volatility is at the heart of option trading. If you don't use volatility in your trading, you're probably not being very successful, because what volatility does is it enables you to have what I refer to as an edge on your trades, to set up high probability trades that give you a statistical advantage. And in order to do that, you know, there's a little bit of science involved here. There's a lot of art involved here for sure. You have to start out by understanding what I'm talking about when I say volatility. Now, the word volatility, you know, has of course an intuitive meaning to it, right? When you see a stock that really whips around a lot, well, it's a volatile stock. When you have a stock that is kind of boring and trades sideways, it's a non-volatile, or what I would call a quiet stock. That type of volatility, that's realized or historical volatility. Just in the plain old English lay definition, realized volatility is how much the underlying stock has moved around lately. Specifically what it is it's the annualized standard deviation of an asset price. Implied volatility, that is the important one to understand, and that is the more difficult one to understand. Basically what implied volatility is it's how cheap or expensive options are. Specifically, it's the volatility figure that is likewise stated in terms of annualized standard deviation that when entered into an option pricing model spits out a theoretical value between the bid and the ask, reflecting current market prices. Now, you might ask yourself, well, that sounds like a pretty complicated definition. What does that have to do with how cheap or expensive options are? Well, it goes to the heart of option trading, like I said, where options are priced somewhat on the market collectively, all the market participants, estimation of future volatility. And that goes to the point of, well, people buy options to hedge when they think the market might be volatile. They sell options to generate income when they think the market might be slow or quiet. So what it is it's the volatility implied by option prices, but when used in the proper knowledgeable hands, this can give you a statistical advantage to all your trades. Okay, How many people use the VIX or look at the VIX on a regular basis? Who uses the VIX in their trading? Yvonne uses the VIX. John does. Anthony, or for those of you, thank you, those of you on the south side of Chicago where I'm from, I would refer to you as Anthony. Sophie rarely does, okay. John does. Hagatha, is that how you say that? Does not? Okay. Well, we've got a mixed bag. A lot of you guys do look at the VIX. The VIX is actually really important. And here's why. Because knowing that volatility is important in your trading, the VIX becomes an important benchmark to whether options are cheap or expensive. Everybody looks at the S&P 500 index just to get a general gauge as to, hey, what's the market doing today? Well, the VIX says, hey, what's the volatility doing today? Today, in general, are options cheap or expensive? That's what the VIX tells you. What the VIX is the CBOE volatility index. And it can be defined a few different ways here, and we're going to go through that. The specific definition of the VIX is it's the volatility of a synthetically created 30-day option on the SPX. The SPX is, of course, the index that is the S&P 500. So what they do is, because different options can have different volatilities, you know, the May could have one volatility, June could have another, July could have another, and this strike can have a different volatility than another one. What they do is they sort of average them all together. They take at the money, out of the money, and in the money calls, sort of normalize them, average them out. And then if there's not an option that expires in exactly 30 days, they'll take the one that expires in a little less than 30 days, the one that expires in a little more than 30 days, and they'll weight them to basically come up with a normalized 30-day contract. So you're always looking at a 30-day volatility, and this is an excellent guide. It tells you, hey, in general, what's going on in the options market? Are options a good deal here? Are they cheap? Should I buy them? Or are they expensive? Or should I be selling them? So it's a great benchmark just to work into your daily routine of looking at different indexes to get a feel for what's going on in the world. The Dow Jones Company publications, or, you know, Barron's Wall Street Journal, they refer to the VIX as the fear gauge, because that implies that when the VIX rises, it's because the market is scared and investors are buying puts. The VIX can be used as, well, some people use the VIX as a directional indicator. And that stems from the observation that when the market goes down, volatility tends to go up, which is kind of tied into what I just defined as the fear gauge. And when the market goes up, volatility tends to go down because then people don't need puts. They sell out that protection and they instead do things like write covered calls. There's an implication here that's predicated on some unreasonable presumptions. This implies that the VIX is a leading indicator. This implies that people first buy their puts and then the market falls. That premise has a very false assumption, and that assumption is that traders and investors are always correct. They always know exactly when to hedge and get in at just the right time. Well, guess what, guys? I've been in the options business for about 20 years, and it's my observation that hedgers and investors are very, very often wrong. People love buying puts after the market falls. Those puts aren't going to do them any good, but that's when people buy puts. You guys, hopefully not. you guys are probably the smart money as far as traders go, because you're here trying to make yourself a better trader. You're learning, you're taking classes, you're trying to get better. So you probably have a little bit more foresight than the typical investor who hedges at always the wrong points. So really, the VIX isn't so much a leading indicator. That's somewhat of a fallacy. Here's another fallacy, that the VIX is an estimate for the future volatility. This, of course, is predicated on the concept that investors and traders buy options when they collectively expect the market volatility to rise. Now, that's partially true in my experience, but it's not always true, and it's predicated on that same false assumption that these traders are always going to be correct. There are plenty of times when even a hedge fund or an institutional trader who, might buy 500 contracts, 1,000 contracts at a crack, there are plenty of times when those guys are wrong. I was a market maker down on the floor of the Chicago Board Options Exchange, the CBOE, and I saw plenty of times when a trader would come in and make a really huge trade and they'd be wrong. And plus, you don't really know why people are buying or selling options. If somebody comes in, even a big firm that comes in and sells 1,000 calls, does that mean the market's going to go down? No. Not only could they be wrong, but you don't really know what their motivation is. Maybe they're selling those calls because they think the market's going to go down. Maybe they're selling those calls because they own the stock and they want to put on a covered call, and they actually want the stock to go up slightly, up to the strike price. Maybe it's part of a spread. Maybe it's part of an interclass spread where they're long options in Ford and short them in GM or something like that. So there's a lot of false assumptions here. And while volatility can give us some indication as to what the market thinks future volatility will be, there's plenty of noise. There's plenty of mispriced volatility. Plenty of times when implied volatility is higher than what actually ends up happening during the life of the contract. And that gives us opportunity. The smart money option traders make money based on that. So that was kind of an overview of volatility. Does anybody have any general questions about volatility before I go into the current VIX picture, future outlook of the market, and how you can trade better in this low volatility environment and some of the considerations that you have? Anybody have any questions right now? Speak now or forever hold your peace. TS says, why does the VXX move too much? Well, let's wait on that one. That can become a very, very long discussion. VXX is we'll get to that one later. Jim says, when should we not follow the VIX? Oh, Jim, I'm going to talk about that. Yvonne says, do you use VIX or VXN, etc. as well? Well, you know what, Yvonne? Definitely use the VIX. Definitely look at the VIX every single day of your life. You're on vacation, look at it on your cell phone. No, I'm just kidding. When you're trading, though, always look at the VIX. Now, maybe you can make a case for looking at the VXN, that's the VIXN, that's basically the VIX on the NASDAQ, and VXO, VIX on the S&P 100. That's fine. I would liken that question to saying, hey, should I just look at the S&P 500 or should I look at the NASDAQ too? Well, you know, the S&P 500 gives you a pretty good broad picture. You want to fine-tune different sectors and stuff and look at, you know, other indexes. That's okay. The VIX is an indicator, Hagatha says. Yeah, well, the VIX is an index. It is the index that measures the implied volatility of the S&P 500. And James kind of hits it right on the head. Value versus price expectation. Yeah, that's sort of at the heart of this presentation and what we teach here at Market Taker. Jim says, does the VIX apply to the spot currency? You know, I don't know. I mean, if you're looking at all your different indexes and such, you know, you probably look at the dollar and such alongside the VIX, and could you make a case for there being some interrelation? Kind of, but it's not really directly related. Okay, so here's the deal. Right now, the VIX is very, very low. Where did the VIX close today? Somewhere around 12. The VIX closed at specifically 1206. So it's actually up a little higher than it was a couple of days ago or last week, but still it's historically pretty low. And what that implies is complacency. And you can look at that not just with the VIX, but even in volume numbers. I mean, how do you make money in this market? Well, I mean, if you don't know anything and you got long the market at the beginning of the year, you did kind of all right. This is not really a trader's market, you know? I mean, people making money in this market, it's not necessarily the case that you're some fantastically great trader. Maybe you are, but maybe you just got long and at the beginning of the year and you're doing fine. Or, you know, maybe you've been selling put spreads all through the year. But Jim says that's the truth. Yeah. So the thing is that in a complacent market, one of two things can happen. One, well, it can keep being complacent for a long time. Back in the beginning of the dot-com bust, I worked for a proprietary trading firm that was run by a really, really smart guy. But he made a mistake. He made sort of a critical mistake that I learned a lot from. He looked, and this is the beginning of the dot-com bubble, he looked at stock prices. And he said, you know what? All these dot-com tech companies are all overvalued. And so you know what he did? He started shorting them. He started shorting the market as a whole. He shorted the NASDAQ. And guess what? As the months went by, the market kept rising and he kept losing money. And he lost a lot of money. Millions. But then the following year, he said, you know what? If these were overpriced last year, they're extremely overpriced this year, and so he shorted more. And he lost more. And then the next year, the prices were even higher. And you know what happened? He said, basically, if you can't beat them, join them. And he started getting long the market. And it actually worked out for a while, and then, of course, he was probably on the wrong side of that and ended up losing money. He's a pretty smart guy, but he kind of made this critical mistake. And the critical mistake was that just because you think something should happen, it's going to happen. That was prior to Alan Greenspan's infamous comment about irrational exuberance. So this market can continue the way it's been going, but what a lot of experts think is that the market could have a sell-off. And there's going to have to be something that triggers it. Probably in this highly complacent, low volume, low volatility market, the market's just not going to turn around and start dropping for no good reason. But because options are so cheap, what could, if an event happens, now maybe something, you know, really boils over seriously in Iraq, or, well, we can imagine many, many, many different scenarios. People are going to wake up and they're going to snap up options, and volatility can pop in an instant. So right now, options are very, 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 very cheap. But does that mean we should go in there and buy them? Well, that's the trick to it, isn't it? If you're a hedger, you could make a case for saying, yeah, I probably should be buying my hedges now. If it doesn't work out, that's okay. I'm just spending a certain percentage of what I've made this year to buy some insurance to protect against an event. If you're a trader, there's no signs right now whatsoever to go in there and take a bearish position. So it's a challenge trading in a low volatility, low volume market. However, there are some trades out there that I like, and we're going to talk about a couple of those trades right now. Let's see here. Which one of these can we get? This one. Okay. Let's start with, we were just talking about this prior. So, I don't know, Tesla had some sort of breakout. I don't know. I'm not in love with that. The chart we were looking at earlier, here's an interesting setup. Take a look at this. So we've got somewhat of a pivot point right about here at the, $38.25 level or so. We got a little bit of a bounce. Now, a little bit lower than there, as of today, the 50-day moving average is at 37.55. So that's going to provide a level of support. We've got the volatility. The implied volatility is the red line down here on my chart. The implied volatility is 35.5. Now, a couple very important things to note. That's in the top half of the 6-month range. That means relative to themselves, options in Delta Airlines are actually somewhat expensive. Compared to historical volatility, the implied volatility is high. So this is one of the anomalies out here. This is the needle in the haystack. In a market where volatility and option prices in general are extremely cheap, here's one where they're not. So this is a great opportunity to learn something here. Look at the VIX as an index, but when I know that volatility is low across the board, here's an opportunity where it's actually high and it's actually slightly overpriced, and I love being able to sell expensive volatility in a low volatility market. I love it. So this is a fantastic opportunity for a put credit spread right here. I mean, we could go in, I could look at this, probably look at the maybe June 27th expiration, sell the 38, well, maybe I'd look at the July 3rd expiration, sell the 38.5 puts for 72 cents. They're $1 out of the money. And then I could buy the 37.5 puts for 47 cents. What is that? A quarter, right? Not a bad little trade right there. I was also looking at a chart in Baidu. Now what I like to start with is I like to start with the stock chart and the volatility chart at the same time. So look at this. What do we have? We've got higher lows. We've got higher highs. We busted up through the 200-day and the 50-day moving average earlier this month. No, last month. It's a reasonably strong chart. We broke through this pivot level right here. We've got a pretty strong stock technically. Now it might be waning a little bit, so I'd have to decide exactly how I'm going to play this. In the options market, the first thing I need to do is I need to look at the volatility. So this is a somewhat inconclusive volatility chart here. We've got the implied volatility relative to itself near the bottom of its 6-month range. So I like that. But it's above historical volatility. So on the one hand, the options are cheap compared to themselves. On the other hand, they could be a little bit cheaper compared to the historical volatility. So when you see an inconclusive volatility chart here, what I like to do is I like to hedge myself somewhat. So I wouldn't go out here and buy a call because, you know, I would rather see cheaper volatility if I'm going to go out and buy a call. Plus, because we see that, you know, we've lost a little bit of momentum over the past 4 trading sessions, I don't necessarily need that unlimited profit potential that comes with buying a call. I would rather use a bull call spread that has limited profit potential. However, I pay so much less for it. I'm able to put on a cheaper trade that I can make a much higher percentage trade. And if the stock is trading right around my short strike price at expiration, I'll actually make more with the bull call spread than I do with the call. And since the volatility chart's inconclusive, the bull call spread's clearly a superior way to trade this. So what I would do is I would look at a chart, probably look at the July 27th expiration, if I can pull it off, which I think I can here. I would want to buy the 175 calls because they're somewhat in the money, which gives this a higher delta. Those calls will profit or lose alongside the stock pretty well. And then I would want to sell the 187.5 calls. Now, why the 187.5 calls? Because I think the highest the stock can get up to is about 190. I think that's a pretty reasonable target. And so what I want to do is I want to sell a strike close to my price target, but, you know, I'm willing to give up a little bit of potential profit and sell a slightly lower strike, the 187.5, because I'm able to collect $1.13 compared to the 81 cents I'd be able to collect with the 190s. So 175, 187.5 bull call spread, that's a nice little trade right there. As long as the stock is at or above 187.5 at expiration, I reach my maximum profit potential, and it can be pretty leveraged, and I'm going to make more with the bull call spread than buying a call if that happens. Jim says, I'm not an options guy, but why can't you sell a call or buy a put at 148? At the 148 strike for Baidu? Well, I mean, Jim, I'm looking at this as a bull play right here. You know, I think that there's probably the potential for a little bit more room to the upside. I mean, tops take longer to form. I'm definitely not calling this a top right here just yet. You know, if it pulls back and we get a couple of down candles, then I would say, okay, forget it, I'm out of my bull call spread. We can talk about something like that. But, you know, with this resistance or with this support level here at 148, I mean, I would be looking for the stock to, if anything, maybe pull down to 148. So I would, if I'm going to buy a put, you know, like let's say, for example, over the next 2 days, I end up being wrong and the stock does tick down. We have 2 down days and the top has formed. If I think we can get down to the 148 level, the put I would buy would be something somewhere in the middle, maybe like a 160 put or something, because we want the stock to move through our long strike. I wouldn't want to buy the put at the strike price where I think the stock could get to, because if I hold that to expiration, I end up being right and losing money. So I'd rather buy a higher strike put. Now, we're going to go over a couple of more questions in just a second, but, oops, must have done that wrong. Hold on a second here. But I want to talk about getting trade ideas. So we were just going over a couple of trade ideas that are suitable for this low volatility environment. One enables us to kind of find that needle in a haystack and find the one option, one of the very few options that are overpriced in this market, and go in there and sell them. And then the other one, we're looking at, cheap volatility, but volatility that's maybe not cheap enough. So how do we trade that? Well, we've got to hedge it. Getting trade ideas like this is a challenge. I mean, you guys go out and look for trades. How do you find them? Oh, maybe you run some scanners, but as we all know, if a scanner spits out, 30 results, maybe 3 of them are good. There's still a lot of manual labor involved. What we do here at Market Takers, every day we scan the market, and we've got a daily class where we give you basically all the trade ideas you could possibly need. We give you about 15 trade ideas every single day. Do you think your trading would improve if you had trade ideas from somebody who's been in the options market for over 25 years, a guy who used to work at Goldman Sachs? You think your trading might improve that way? Well, ask and you shall receive. The Market Taker Live Advantage group coaching class gives you 15 trade ideas a day from a guy who's been in the options business for over 25 years, who used to work for Goldman Sachs. Like right now, John, my head coach, is sitting next to me scanning the market for tomorrow's trade ideas. Every day these classes are during market hours, 9 a.m. Central Time, that's 10 a.m. Eastern Time, a half hour after the market opens. If you miss a class, the classes are recorded, no problem. Even if you attend the class and you just want to review some of the trades, this class is a great earn while you learn sort of scenario. Some people attend the class just to get the trade ideas and trade them. Some people attend the class to learn, to be put in the mind of somebody who's been in options for 25 years and learn that mindset and learn to be a better trader so that they can find the trades themselves. So it's great learning. It's a great idea generation source that saves you time. Spend an hour with us instead of spending 3 hours looking for trades on your own. And plus, I think you're going to like the guidance from somebody who's an experienced person. So here's what we're going to do. Today only, I'm going to let you into this class for free. This is a new thing that I'm doing. I'd never done this before because, frankly, we priced the class at a pretty reasonable cost anyway, where if you make money on like one trade idea, it pays for the cost of the class. But I think you're going to like this class so much that I'm going to let you try it out for free. After 2 weeks, then you only have to pay the monthly discount subscription price forever, for as long as you want. Normally this class is $997 a quarter, which, think about it, you make money on 2 or 3 trades, it pays for the class. But you're never going to have to pay that. You take me up on this 2-week free trial, and after 2 weeks, you just pay $225 a month. If you stay in the class and like it, you don't have to. So, ready, set, go. MarketTaker.com/GC2W. That's Group Coaching 2 Weeks is what that stands for. MarketTaker.com, 2 T's in a row, /GC2W. This is only the second time I've ever offered this deal where you get to try this class for free. I've always looked at it as much too valuable of a class to let somebody in it for free. And frankly, I've never had to let people in it for free. But you know what? I kept having people ask over and over and over again, hey, you know, can I try it for free? Can I try it for free? So I finally decided, you know what? This is a class that sells itself. I mean, you go in that class, you make money on a couple of trade ideas, and personally, you know, frankly, I think you're going to be hooked for life, and you're going to be dying to be in this class. So try it for free. Try it right now. MarketTicket.com/GC2W. Now I'm going to answer some questions. If you have questions about this class or about the presentation that we just did, send in your questions and I will answer them. Hagatha says the VIX market is low, but the stock volatility is high. The options still too expensive? Yeah. Well, yeah, because you're trading, like you're talking about the Delta Airlines trade. You're trading options on Delta Airlines. So that's the volatility you're selling. It's good that the VIX is low because that means there's a better chance that Delta stock doesn't move that much, and that's a trade that makes money if the stock doesn't move too much. And you know what I'm going to do, guys? For the first 5 people who sign up for this class, you know what I'm going to do? I'm going to give you a bonus. Not only are you going to get 2 weeks free of this class, Bruce says he was having a hard time getting in there. Here, hold on a second. I'm going to go down to chat, and I'm going to type it in. Hold on. /GC2W. Just go down to where it says chat, and you can click on that link. It should go through. I mean, I tested it right before the site brew, or right before the presentation. But I'm going to give you guys a bonus. Anybody who signs up for this right now, I'm going to give you 3 months of access to our community chat room. I hired some of the best programmers in the world, had them build basically Facebook for traders. I sell that for $197 a month. You're going to get 3 months free. That's about a $600 value that you're getting free just for trying out this class. None of this costs you anything until you decide if you like it. So that is only for the first 5 people who sign up for this class. So you got to be quick. You know what? I realize that I announced this after some people already signed up. I'm going to do it for the first 10 people. The first 10 people who sign up for this class, you're also going to get a $600 value access to our community chat room for 3 full months. It's another great resource for trade ideas. KB says, does this 2-week require a credit card? Yeah, here's how it works. You sign up. You put in your credit card. If after 2 weeks you stay in the class and you don't cancel, then you get the discounted price of $225. However, if for some reason you decide, hey, this class isn't for me, I don't want it, we send you instructions. You get an automatic generated email when you sign up that tells you how to cancel the class. So it's a breeze to cancel. If you cancel within the first 2 weeks, you are never charged. It is no problem. So yes, it does require a credit card because if I do it any other way, I'm going to spend like, you know, an hour a day emailing people back and forth. Hey, do you like it? You're going to stay in? Oh, here, let me get your credit card, blah, blah, blah. This is easiest for everybody. Chris says, how do we know if we are in the first 10 that signed up? Chris, is your full name Krishnan? Because you are in the top 10. Okay, you know what? You're right. You're right. Here's what I'm going to do. Mark, better than this. Mark says, can you name the top 10? Here's what I'm going to do. Every single person who signs up while we're on this webinar right now, you're going to get that 3 months free. Because it's too big of a pain in the butt to see who's in the top 10, who's not in the top 10. You sign up for this class right now, you're going to get 3 months of our chat room. Brew, you are welcome. So Chris, Mark, you're in the top 10. Bruce in the top 10. It doesn't matter. Everybody's getting it. Okay, do we have any other questions? Yes, James has a question. He says, what trading platform do you use? I use LiveVol. That's the platform that I was using. I think it's a really great platform. If anybody is interested in that platform, send me an email. I'll give you my email address in a second. I got a guy there who you can talk to who gives my students a discount price, I think. But he can tell you about all that. I do not work for LiveVol, but I think they're great. And we do some collaborative stuff together. Does anybody have any more questions, again, about today's presentation or about this class? I would love to answer any questions that you might have. Anybody at all? Nope. All right. Great. Hey, thank you for spending your afternoon with me. I hope you found this informative, and looks like a whole bunch of you guys took advantage of this special I'm giving you here. I don't know what the heck I'm thinking. But it's just, you know, like the thing with these classes is, you know, everybody's hesitant, which you should be as a consumer. Hey, you know what? I don't want to spend $900 or whatever trying out a class, even if I get a discount. You know, I want to see what it's like for free and see if I like it. So, you know, we get great feedback on this class. I mean, on our website, we have a ton of testimonials about it. Like, you know, hey, thanks, you know, I'm making money on this trade, blah, blah, blah. And for that class, I've never actually, I don't think I've ever actually asked for a testimonial. Almost all the testimonials on that site, if not all of them, were just customers who sent us in some email that said, hey, you know, thanks, this is really awesome. And I said, hey, by the way, can we use that as a testimonial? So you're going to love it. Oh, we actually do have a couple questions here. Mike says, does the VXX emulate the VIX? Kind of, but not very well. The VXX is a very, very convoluted contract. You can trade options directly on the VIX, and I think that that's a more pure way of doing it. But really, I mean, you have to keep in mind here, guys, you have to keep in mind the VIX, or you're trading volatility, even if you just trade out, like if I buy DAL options, I'm trading volatility on DAL. I don't have to trade the VIX to trade volatility. I'm trading it, whenever I trade options, I'm trading volatility. So, you know, don't, especially if you're new to options, don't get hung up on thinking you have to trade the VIX or anything like that. All right? Just don't worry about it. Just stick with regular options, especially if you're new. I hear there's so many horror stories I get from students, you know, new traders who lose their shirt trading the VIX. You know, all right. Anyway, I digress. Anthony, I got your email here. I will pass that along to my guy at LiveVol. He'll take good care of you. Chris says, so the free access is to the trade room. Yeah. Well, Chris, you're getting two things free. I'm, you know, crazy here. You're getting 2 weeks free to this class. It's an everyday class. And then after that, if you stick around in the class, you pay $225 a month, which is the frickin' steal. Normally it's $1,000 a quarter. So you're getting like, what, 25% discount or something off there? And it's broken up into easy, smaller payments. But you're also getting access to my chat room. It's basically Facebook for traders. And what most people, we actually have a good number of people in the room, but we don't get a lot of chatting. Most of the people are in there just to get trade ideas from John. So you're going to get access to that for 3 months. Jonathan says, I've tried credit spreads, and the few times that I've lost wiped out all the wins I had. Do you teach how to defend against those trades? Yes. That's the thing with credit spreads. If you're not careful, one loser can wipe out, 10, 20 winners. So we talk about trade management on the trades. Like, this is not just an alert service where we say, hey, go trade these trades. This is a service where we say, hey, here's a trade that we really like. Here's how I would trade that. Here's how I would manage that. And then like a couple weeks later, we might say, hey, remember that trade idea we talked about 2 weeks ago? Well, look, here's a nice time to get out because of this, So, yeah, I mean, I was just talking with somebody on the phone the other day. I mean, there's two parts to every trade. There's getting in and getting out. Getting in establishes your risk reward, locks that in, your percentage chance of winning, locks all that in. But where you get out determines if you make money. So, yeah, we definitely talk about that in the class. Chris says, how frequently do you meet in the chat room? Well, think of it as Facebook, okay? Think of it as Facebook for traders. You have access to it basically 24 hours a day. I mean, there's not a lot of action there at night. It's mostly during trading hours. But John, our head coach, pops in there several times a day and gives some market musings and, sometimes some trade ideas. You can ask John questions. It's a great place to ask John or other traders questions. You can even, come up with like a little avatar of yourself, put your picture up there. You can share charts of stocks and say, hey, look at Apple right here. So it's just a really great resource that I think you're going to love. All right. Any other questions? Anthony, I got your email. I'll pass that along to my guy. Write this web address down here, markettaker.com/GC2W. Like I said, this is valid for today. If you decide an hour from now that you want to do this, no problem. But I'm glad we could offer this to you guys. Once again, my name is Dan Passarelli. If you have any questions, email me, dan@markettaker.com. And follow me on Twitter, twitter.com/Dan_Passarelli. Twitter's free. I give some market musings and personal thoughts and give you a trade thought of the day, a trading tip basically of the day. All you guys who signed up for this class, you will be getting login information within the next couple hours. I'm going to pass along all your names to Amy. Amy will take good care of you. We love Amy over here. She loves you, and you will love her. She's going to send that out to you, Mike. All right? Okay, guys. Hey, have a great day. Thanks for spending your afternoon with me. I had a great time. I hope you did. I hope you learned something, and we'll talk to you soon. Have a great day.